It's nice and loud. I might get underway. Thank you all for coming out today. My name's Sean Ellis. I'm the General Manager of Strategy and Growth at Vision Super. Presenting with me today is Michael Wyrsch, who is Acting CEO and Chief Investment Officer. Today's session, the legal obligations, is just of a general nature. Won't consider individuals' personal circumstances. But we do have teams that can support you with that. Paul and a few of the team are here today, but we've also got the contact centre. If you have a member or an employer query, you can make a call to. Before I get started though, I would like to acknowledge the traditional owners of the lands on which we're presenting today, the Wurundjeri people of the Kulin Nation, and pay our respects to elders past, present and emerging, for they hold the memories, traditions, the cultures and hopes of all Aboriginal and Torres Strait Islander people. We extend that respect to any Aboriginal and Torres Strait Islander peoples here or on the call today. Again, thanks to everyone who's joined us here in person. We're also streaming this to people online. For people that are online, you have the ability to ask questions. If you head down to the bottom of the stream, you can enter your questions there. For people in the room, Paul has a microphone and we can take questions at the end of the session. Just a reminder, and I'll do the same myself, for people in the room, if you need to take a call, perhaps just step out, but if you could silence your phones, that would be appreciated. I'm going to start with an update on the fund. We're in the middle of a merger at the moment with Active Super, so I'll talk to that a little bit. I'll then go into a bit of detail on the defined benefit, some of the history, where we find ourselves today, and then I'll pass over to Michael, who will provide an update on the membership profile, the cash flows into the fund, and the impact of returns and investment markets on the plan. So firstly, from a fund perspective, this slide is looking at performance of the fund until 30 June 2024, and not specifically looking at the DB, but more broadly the entire fund. And for a number of our key strategic metrics, we've had a really strong year. Our balanced growth investment option, which is our default option, which most of your staff and for people that don't make an investment choice will find themselves invested, remains top 10 over the long term, over 5, 7 and 10 years. And that's comparing to Super Ratings benchmark, where they compare 50 of the largest MySuper products. That option's performance though, as you'll note here, I'll use on this year, 1 year, we returned 8.42%, which was below expectation and below median. But what that option has delivered for members is a positive return over 15 years. And so it gradually continues to add to members' balance. And our focus for that option is to produce long-term returns. So Michael and his team will continue to look at how we improve that. But over the long term, probably the performance remains very strong. Also on this slide, we call out membership, total membership and membership growth. The fund for a long period of time had started to decline in membership. The last 2 years we've turned that around and have just grown to over 85,000 members. I'll speak to the merger in a few slides. That will double when we finish the merger. And that's really important because scale enables us from a defined benefit perspective to ensure that the services that we deliver, the administration of the defined benefit, but also the broader fund can continue to be delivered for the members and the employers at the expectation that they have today. In line with that, we've also seen assets grow to nearly $14 billion. That may have dropped a little bit in the last week with investment markets. And we continue to see strong satisfaction across our membership. And it's not just us. We survey at transaction. So if someone calls the call centre, if someone meets with one of the team, we survey members and that score is out of 10. It's remained consistently high. But that's not just us doing that. We also received an award this year from Super Ratings and SuperView on providing quality service. And so that's really pleasing to us that because it is a focus. Superannuation is a complex product, and we consistently see as we're helping members plan for retirement, understanding superannuation is one of the challenges that they face in making good financial decisions. And so it remains a focus for us, and we're pleased both internally to benchmark to that, but also have that validated externally. As I said earlier, we're in the middle of a merger with Active Super. Active Super is a very similar sized fund to Vision Super, servicing the local government in New South Wales. Again, about 85,000 members, similar to us, very similar assets. And so nearly 2 years ago now, we started a conversation with them about merger, which we're seeing a fair bit of in the sector, driven partly by legislation and regulation, but also by funds looking to see how they can continue to deliver the services that they need to in a complex environment. The merger between Active is well underway. We're in the middle of the transition where we're building the platforms to bring their products on. We aim to have that completed by the 1st of March next year. And our expectation that the large majority of that work will be finished this year. So we can return after Christmas and do the training and business readiness activities to ensure that we're ready to go when we launch on the 1st of March. What I'd also say though, business as usual activity continues to be a focus because we understand, as I sort of spoke about on a couple of slides, that service and meeting the expectations of members and employers remains paramount. And some of the benefit that we're seeing through merger, we've done a lot of work with our insurer, and we will see a premium reduction for all Vision Super members that will communicate shortly to insured members. And so there will be a number of benefits. Admin fees will reduce at merger date, insurance premiums will reduce in the coming months, and we'll see the opportunity to deliver more strategic benefit to members through service, offerings and products. So now I'll probably get into a little bit more detail into the defined benefit and our LASF plan. I'll start with a little bit of history, and some of the questions that have come through sort of have been around markets and how it impacts the defined benefit, how calls are calculated, and I'll touch on that throughout the presentation. But just to provide some context, the plan started back in 1947 and was at that time was based on insurance policies. The benefit calculation was replaced the insurance policies in 1961, and then we saw significant change over the next years that received no funding to support that change. So in 1976, lifetime pensions were introduced using the calculation factors around time in fund and scheme service period. No funding was provided at that time. In 1982, lump sum benefits were improved, again with no additional funding supplied to the fund. In 1988, lifetime pensions were closed, and a 30-year funding plan was implemented. In 1993, the DB plan was closed to all new members. And so we're seeing now the runoff of the DB members that were members of the fund at that time of closure. But at the same time, that funding plan that was agreed was abandoned. I know you're all acutely aware of the funding responsibility of council, and that history just talks to how the scheme changed with very little funding applied at the time. In 1995 and 1996, there was a restructure in local government which saw Vision Super, or LASF at the time, pay out over $1 billion in payments. In 1997, we saw the VBI at 73%, which required us to call to the sector to the magnitude of $321 million. So how does the VBI, or Vested Benefit Index, I should stop using that acronym, the Vested Benefit Index work? It is a funding indicator. And so we need to be at 100%, which effectively says that every member, if they were to retire or leave the scheme at that point, we could fully fund and pay every liability that fell due. And so through regulation and SBS, if you're ever interested and can't sleep, SBS 160 requires funds to maintain a satisfactory position and looks at whether we're either satisfactorily or unsatisfactorily in a financial position. As I said, do we have the ability to pay all benefits at that time? And when we're doing that calculation of the VBI, there's a number of assumptions that we consider. Net investment returns, salary increases, and we've just considered that as we've done our 30 June review, but also price inflation. The assumptions obviously vary, and they'll vary depending on stuff that Michael will talk about, the strategic asset allocation for the plan. Currently, the anticipated earnings for the plan is 5.7% or 6.5% untaxed. And we're using a 10-year assumption for that target. And we also obviously consider long-term salary growth. The next slide, one of the factors that I spoke about is investment performance, and that's a significant factor in how the VBI fluctuates. This slide looks at the vested benefit index on a quarterly basis over a 12 to 13 year period. So you see significant volatility here. I have highlighted with a circle on this slide a period 6 months ago, which was December last year and then the start of this year. And you'll note here at no stage does the VBI reduce below 100 because we're tracking points on a quarterly basis. So the December number and then the March number remained above 100%. But you also monitor the VBI more closely when we're seeing volatility in the market. And for a short period over that time, the VBI reduced below 100. And Michael's going to talk about volatility and the impacts of market a little bit later. And so why tracking that number is really important, we have VBI thresholds that indicate to us what we need to do engaging with the regulator, engaging with employers, and potentially having a funding call. And those thresholds change at different periods of the year. And so as I was talking about, we're at December. Our December number was above 100. Through that period, it dipped down. At March, again, it was back over 100. But as you can see here, at different stages, we have different thresholds. 30 June, when we do an actuarial review, it needs to be 100. At all other times during the year, it's 98%. It was previously 97, but as we've changed the asset allocation and therefore the investment assumptions, that number's increased to 98%. And so we continue to be really sensitive, or the VBI does, to investment market movements. And so how do we manage, or what happens if there is a VBI shortfall? We drop below one of those thresholds. Firstly, what we'll do is inform and discuss that with all participating employers that have an obligation. We would then formulate and implement a restoration plan. And a restoration plan really is aiming to bring the VBI back over 100%, and we can do that within 3 years. A restoration plan doesn't have to include a call. We can assess what's happening in the markets, and hopefully, depending on how low the VBI has fallen, we could return over 100 just simply through investment markets moving. We'll discuss it obviously with the regulator and also employers. And then lastly, the one that probably is a risk not only for us, but obviously employers, there could be a funding call. Outside the funding call, employers have obligations to the defined benefit plan. As you'd all be aware, you receive quarterly invoices that tell you how much you need to pay. And so employers are required to pay significant contributions. They are set in the invoice, and they are determined based on us maintaining a satisfactory position. So paying all liabilities at any given day and maintaining that VBI above 100%. The percentage that employers are contributing is tied to the superannuation guarantee, And so that's increased over a number of years and has one more increase to 12%. So you'll see that flow through to your invoices next year, as has happened this year to 11.5%. So what is a funding call? So the funding call, as I've sort of alluded to through a lot of the slides, is where the VBI has dropped below that 98 or 100, and we've spoken with regulators and we've spoken with employers, and it's deemed that we need to make a funding call to get us back into a satisfactory position. So the liability we need to bring back over to 100. So it depends on the size of the unfunded liability. There's a number of ways that we can return to a satisfactory position. The funding call won't always need to be paid in a one-off instalment, which a lot of councils did through the last arrangement. There is the possibility to pay that through instalments, and it will depend on a number of factors, which I'll also talk about over the next slide. How big the unfunded liability is, the expected returns, have we just ground down over time and slowly trickled under the 98%, or have we come down through a big market shock? And then also the expected timing of DB retirements and resignations. So I was speaking to someone in the room earlier about the profile of the membership, which Michael's going to talk to, and how many members are left. If I go back 10 years, we've well and truly more than halved how many active members are in the plan now, and we're seeing that come off reasonably quickly. So calculating that funding call, I think, Rebecca, which was one of the questions, there was a funding arrangement agreed back in 1997 by all authorities, and it was called the Apportionment method. The method looks at pre and post 30 June 1993 components, and it's based on three segments of the membership: active members, pensioners, and also deferred members. So it's not uncommon when we're out talking to councils that some councils believe that once their active members are gone, their liability's gone. But that's not the case, because they potentially have deferred members or pensioners that will contribute to a future call. The components of that are also then impacted by demographics. So probably jumped ahead a little bit there. How many members that you have left is a factor. So the post-93 component, so we're now looking at active members, employers with reduced active members, so from the historical agreed upon position, that have reduced their active member salaries, so less members, relative to the last funding call, so relative to when we had that agreed position, will most likely see a reduced call in that component. And then the reverse applies. Those with more would expect a greater proportion of the call. For the pre-July 93, this will increase in line with increased pensioner representation of the total liability. So as we run off the actives, obviously the pre-93 becomes the only component if there's no active members left, and that's the point that I was alluding to. A lot of authorities will find themselves in that position in the coming years. We do have a lot of the smaller authorities, cemetery trusts, already today without any active members. So I've sort of given the history. I'm going to hand over to Michael, and then we'll take some questions. So Michael, I might hand over to you.
Thanks, Sean. So this is just the profile, the membership profile over the last 6 years. Well, 6 years to 23. And there's a couple of things to look out for here. One is the number of active members. It's shrunk quite a lot, 57%. So the scheme very much is in its mature phase. But also the pensioners now, the lifetime pensioners, that number's also starting to fall. That didn't used to happen because every time a pensioner died, we get an active member coming in. But now the number of active members becoming pensioners is less than the number of pensioners that are dying. So we're now in a state, after being in a fairly stable situation, where those numbers will decline. You can see the salaries there. I mean, the benefits, the value of the benefits are quite high. And that's continued with membership. Of course, it's closed, so every year remaining members have more service, typically a higher salary and a bigger benefit up until 40 years of service, which we'll get to. They'll all have to be at least 40 years by 2027, I think. The other point I wanted to make here was just on what Sean was saying about contributions and salaries. So the contributions that we get now are very minor. They really don't have a big impact on the VBI, but the salaries do, because they flow straight through into the benefits. So if a member gets a 3% or 4% salary increase, that benefit will go up 4%, and those benefits are quite large in general. So moving on, this is just showing expected cash flows. This is from 2023, the work the actuary did. It's nominal, it's not real. So what I mean by that, it's in 2023 dollars. So if you think of it in terms of your cancelled budget, it will shrink more quickly than it does in nominal terms. And you can see the next 5 to 10 years are really important, I think, in terms of the amount of cash flows that will get smaller and smaller for the fund. And that's sort of a proxy as well. We'll see on a couple of slides time, but it's a proxy for the potential liabilities for the plan. Moving on. This is just a chart showing returns for the plan for the last, I think, almost 20 years. We've had one call in that period, which is, actually we've had two, 2008, and then we had another one, I think, in 2011. And we haven't had one since then, which is a long time, actually. That's not what we would have expected back then. We didn't have a call in 2020. We did pretty well that year. But our modelling suggests we will get another call, at least another call. That is our expectation. It's always been our expectation. What we are seeing, though, is the potential size of that call. Should it come, it's not definite, but should it come, will be smaller than it would have been in the past. And that's part of our strategy here, is to try and minimise any damage. I mean, the reality is we have to be above that VBI limit Sean was talking about all the time, and it's very hard. You know, you can't, if you want to earn decent returns, you get volatility, as we've seen in this chart. And so it's very hard to get a decent return and avoid volatility. You really can't do it. So our expectation, as I said, is that we're likely to get another call. The other thing that happens as this plan matures is your expected returns have quite a big impact on the VBI. So when I joined Vision 10 years ago, if we reduced the expected return by 1%, the VBI would reduce by 3%. Today, if we did that, it would reduce by 6%. And that's just going to continue going up until we just have pensioners left, I think. Of course, it goes the other way. If expected returns go up, the VBI will also go up. So there is a little bit of a shock absorber in there, but it is becoming more volatile and a greater sensitivity to that expected returns. This last, thank you, Sean. This last chart just shows the vested benefit projections, and you can see it coming down there. Again, this is in nominal terms. We can get to 2030 without a call. That'd be fantastic in my view, if we can do that. And after that, I think we'll see, the size of any potential call becoming immaterial. Nothing necessarily, but immaterial. So that's where we are now. We're at a pretty critical phase over the next few years. It's been, to be honest, fantastic that we haven't had a call in the last 10. And the impact of any potential call will come down over time. So that's where we lie. I don't want to gild the lily. the chances of another call are quite high, according to our modelling. But we are doing what we can to mitigate that to the extent we can.
So, Michael, on that, there's a question online. Will the latest market correction have an impact on the VBI in the short term?
Yeah, every market move has an impact on the VBI, whichever way it goes. As you said, our expected rate of return is 5.7%. If we earn less than that, it has an impact, downward impact. If we earn more, we have an upward impact.
And so the medium to longer term outlook from an investment perspective, how achievable is that 5.7?
Well, we think it's achievable. That's why the number's there. That's from an independent source. Our consultant models these things. So we absolutely think it's achievable. The question is, what road does it take? If it's smooth, no problem. But if it's like that, then we may have a call, or we may have a funding situation. As you said, it doesn't necessarily mean we end up making a call. So what has improved in the last few years is the return you get from bonds, which are much more stable generally than equities. You're getting around 4%. 4 years ago, 3 years ago, you were getting 0. So that's a nice stable base now, and we only have to add a couple of percent above that to reach our target. So we are, in that sense, in a better situation. Equity markets have been very strong and are quite high. So there is a potential for a correction.
I'll stop asking questions and perhaps pass to the room. There's no more online. Any questions in the room? Paul has a microphone for the people online that he can pass around. Michael, while I've put that out there, I'll ask another one. Obviously, we've seen political change, some political uncertainty, and part of the volatility at the moment. What does the short term look like from our expectation?
Look, we've got a reasonable buffer, and it's we've diversified the plan as much as we can, and it really is the LASF plan. It's Parks and Ports is in a pretty good situation, and City of Melbourne's in an excellent situation. So they're really not going to be affected too much. So the VBI will be lower, but we have had a decent buffer. We have got diversification. So we'll be okay at the moment. It's just if this continues, we get a 20% correction, something like that, then we might see an issue.
Paul?
Thanks. Hi. We've got a lot of members in the water industry super fund. Do we have a similar situation with that and the ports fund?
Yeah, so Parks and Ports.
Yeah, so Parks and Ports, that's a very small fund. That's probably going to be the first fund to mature. That's got a VBI over 115%, and it only needs to earn around 2 or 3%. So, it's, if that gets into trouble, the world's melting basically at that point. So that's in a good situation.
Yeah, you as the employer have members in both, in this bigger scheme, which is a pooled scheme, which is all authorities across local government, the water authorities, and then there's we manage the 2 standalone funds, which is Parks and Ports and a City of Melbourne. And so when Michael just spoke, he's talking about that, but you will have members, you do have members in LASF as well, which is this. Yeah.
That's good to get a good news question.
Just a question on the restoration plan and that 3-year time frame.
Yeah.
Is there a time frame on when the restoration plan has to be finalised, or can you wait for that 3-year period, if that makes sense?
Yeah, so we'll have conversations with the regulator. Will push that to be in place as quickly as possible, and some of it will depend on how quickly we grind down under that 98 or 100, and when we start those conversations with the regulator and the sector. But they'd prefer that restoration plan, and especially if there's, like Michael just spoke to, a big market correction and you're in the 80s, the regulator would expect a plan in place significantly quicker than if we slowly grind down and we're at 97 and monitoring and looking at the market saying, we'd be talking to the regulator, and the urgency would... So it will depend on how quickly we get there.
Yeah, look, the regulations are very restrictive. We do want to talk to government about it because particularly as the plan matures and becomes smaller and smaller, it's very restrictive for something that may end up not being very material. And we would expect as investment people, we would expect, you know, not a smooth path, but a windy path and still be able to make the payments as they fall due. So we do want to talk to government about that. We understand why they've done what they've done, but it is very restrictive in terms of what we do.
And so, Michael, just talk to that. You're in Canberra in a couple of weeks. That continues to be one of the things on the agenda for the reasons that you spoke about.
I mean, one of our strategies, you know, if we get a big fall in equity markets and equity valuations look cheap, we would intend to put quite a material amount more into equities. That's risky because you can get further falls, but the expected returns will be higher, and it's a way for us to get ahead if we can. So again, it'll depend. Every crisis is different, every downturn is different, but that's part of the strategy, and that actually would help the VBI to some extent because our expected returns would go up and our VBI as a result would go up in that situation.
Just while I'm probably pausing for any questions, I should check online. Just a reminder for all the councils and water authorities, you do have a client partnership manager, someone servicing that can always help you with this. We've got our contact centre, so Paul and his team. If you've got any questions that you walk away, we're happy to share the presentation as well, which we'll do via Paul and his team. But at any stage outside of today, if you have any questions, feel free to reach out. It's not uncommon that we present directly to audit committees and different committees to try and, because we understand councillors change. This is a complex product, and we see the closure of most defined benefit plans, so it's even foreign to a lot of people. So if you need that support, that is always there as well. I'll check online, sorry. Nothing. Thanks, Rebecca. So if that's it, please hang around, have a drink, talk to one of the team, but thank you very much for coming out today. I hope it's answered some questions, and if it's created any more, feel free to reach out to us. Thank you. Thanks, Michael.
Oh, applause. I didn't get that.
Applause.